Hey traders, welcome back. It is Thursday, March 5th. So the theme for the week continues, up, down, up, down. I did something I rarely do today, and that is I traded both long and short at the same time. It's very rare that I will ever have multiple positions open, one of them being long, one of them being short. I almost always go in the same direction with everything that I trade, but today I went long on Palantir while simultaneously shorting the IWM this morning. They were both winners, and I just wish that I had held my last contract on IWM longer than I did, because I made some money on a handful of contracts from about 8:35 a.m. until about 8:50 a.m. And then I stopped out my last contract when the price broke above the 200 EMA. In hindsight, obviously I would have made a lot more money if I had held it into the afternoon when it came back down and just continued to fall out. But the lesson here is pretty simple. It broke through my stop out level, and I had to respect my level and not look back with any regrets about holding to my levels. It is what it is. You need to set levels, and then you need to respect your levels. Even in hindsight, you can always go back and look at anything in hindsight and say, oh, if I would have done that, or if I would have done that, it would have been so much better. But the levels are there for a reason. And when the price breaks a level, it is what it is. Just deal with the reality of the situation and then move on. And so that's what I did today. It still made me money. It's just in hindsight, you look back and go, oh, I could have made hundreds more dollars on this one extra contract, but whatever, you still made money. So if you made money, you're doing good. But let's get on to the news for today. Markets just wrapped up Thursday's session, and the story isn't just where we closed, it's where we almost closed. So first of all, let's set the scene here. We are now 6 days into Operation Epstein Fury, the offensive war against Iran carried out by the U.S. and Israel, a war that has killed at least 6 American service members and roughly 1,230 Iranians, with nearly 100 of them being children between the ages of 7 and 12. With this backdrop of war setting the scene, the market's brief sigh of relief from Wednesday's rebound evaporated fast. At the lows of the day, the S&P 500 was down over 1.4%. The Dow was in free fall. It looked like a genuine panic session in the making. But then something happened. Dip buyers stepped in, oil pulled back slightly from its extremes, and the indexes clawed their way back. But here's the thing. The recovery didn't stick. The Dow still closed down more than 750 points, which is over 1.5%, officially wiping out every single gain it had made in 2026. The S&P 500 finished down about 0.5%. The Nasdaq held up best, but it closed down just slightly today still. Bulls showed up to buy the dip. They just couldn't close the deal. This tug of war tells you everything about where trader psychology is right now. On one hand, there's a group that still believes in the markets always shrug off geopolitical conflict playbook. They bought the morning sell-off hard. But then on the other hand, the macro math is just simply getting harder to ignore. WTI crude oil crossed $80 per barrel intraday for the first time since January of 2025. And here's the thing traders need to understand. This is no longer a geopolitical risk premium story. This is a real supply disruption. The Strait of Hormuz, the narrow waterway through which roughly 20% of the world's seaborne oil flows, is effectively closed. Insurance companies have pulled out. Over 150 ships are stranded. Prediction markets now put the odds of a full sustained strait closure at over 86%. When oil spikes like this, it's not just an energy story, it's an inflation story. And when inflation re-enters the picture, the Fed's hands get tied. This is exactly what spooked bond traders today, and it's why the afternoon bounce couldn't finish the job. rate expectations got completely repriced. Just last week, the market was betting on multiple Fed cuts in 2026. As of today's close, traders are pricing in just one cut, and the odds of anything happening at the March meeting are less than 3%. Every time buyers tried to push the indexes higher, the rate cut math kept pulling them back down. The translation: the easy money era the bulls were counting on may be on a pause. The damage we felt today was worst in the most defensive corners of the market. Merck and J&J stocks that were supposed to be safe during war each fell over 2.5%. Walmart dropped nearly 2.5%. And even the asset managers took a beating. BlackRock fell after it slashed the value of a private credit loan to zero, and Bridgewater dropped 3.5%. Financial stocks broadly sold off, with Wells Fargo losing 3%. The one bright spot in all of this: Broadcom. The chip maker surged over 4% after delivering a monster earnings report, record Q1 revenue of $19.3 billion, AI revenue up 106% year over year, and a Q2 revenue guide of $22 billion that blew past the $20.4 billion Wall Street had expected. CEO Hock Tan raised the bar further, saying Broadcom has line of sight to over $100 billion in AI chip revenue by 2027. In a sea of red, Broadcom was a reminder that the AI infrastructure build-out isn't slowing down, even when the rest of the market is. So now all eyes turn to tomorrow morning. The February non-farm payrolls report will drop right before the bell, and in a week defined by war and oil, a strong jobs number could actually hurt markets by further dimming hopes for rate cuts. If the bounce buyers couldn't hold things together today, a hot jobs print tomorrow could test their resolve all over again. So pay close attention at the open. This week is not over yet. I'll see you again tomorrow afternoon. Until then, have a nice evening, everybody, and take care of yourselves. We'll be back tomorrow. Bye-bye.